Todd Doerhing is director of Centrec Consulting Group, based in Savoy, Illinois, and works with clients in areas of financial assessment and analysis, economic and market analysis, education and training, analytical modeling and analysis, and strategic and advisory services. He's an experienced educator and has taught thousands of ag finance professionals on the topics of credit and financial analysis and use of credit analysis software. Todd earned a BS and MS in agricultural economics from the University of Illinois. He is past president of Farm Financial Standards Council and currently serves as co-chair of the technical committee. Well, let's welcome Todd.
Hey, can everybody hear me okay? Am I loud enough? Do I need to talk louder?
She said, this back row says yes, you're fine.
I'm fine. Okay, well, great. Hey, thanks everyone. It is a pleasure to be with you. I see at least one person I know right there up front, Joe. So hi there. And I've known Norm for a long time, many years, as involvement on the Farm Financial Standards Council. So what he had asked me to talk about is just an update of what's going on with the Farm Financial Standards Council. So I'm going to back up a little bit, give an overview of that, of the organization, how it began, and then actually let's just go to the agenda. And then talk about some of the guidelines and resources that it has available, some of the recent activities, and then this last little bit really is more of kind of potentially leading into questions or more of a wrap up, but about using the guidelines. So using those for implementation, how you might use the guidelines to help achieve management goals. So these slides will be distributed, so that bio slide I'm just going to skip over. So the Farm Financial Standards Council actually started in 1989, really did come out of the 80s farm crisis. So I can never remember the exact year. I think it was the 1985 Farm Bill that was it was right in the middle of the crisis. It actually formed or laid out the statutory formation of Farmer Mac, so the secondary market for ag lending. And so as that started to get going, the folks at Farmer Mac realized, we don't have any way really to aggregate all these pools of loans in some sort of consistent way. So the ABA Ag Group, American Bankers Association Ag Group, formed a task force, and it was called the Farm Financial Standards Task Force. And their goal was to come up with some sort of analytical approach in analyzing these farm credits for pooling of these ag mortgages. Well, so that was again in January of 1989. So we're talking now 32 years ago. The task force kind of did what they were asked to do, but they did a lot more. So they were an independent bunch and still are. And the primary mission of the council is really just to develop standards for preparation and analysis of ag financial statements. And I'll go over a little bit more about what that is in a bit. But today, the council has over 150 members. That initial group was roughly 50. And most of those people have retired. There are still a couple of them around. Norm's been around the council for a long time. Anyway, it is comprised of producers, accountants, lenders, educators, extension agents, software developers, advisors, consultants, a whole host of people. And really our continuing efforts after these guidelines were released are to remain current and relevant for ag through maintaining these guidelines. And so, how do the accounting standards that come out apply to agriculture? And we have two primary guides, which I'll go over in a moment. So some people often ask, well, why don't we just use GAAP? And on the back cover of the guidelines, we actually have a statement that says, quote, with respect to GAAP, the council states the following. I'm not going to read this to you, but basically, the council guidelines are not written to say, look, this is an alternative, right? Or something other than GAAP. We're not trying to replace them. In fact, when I say we, I mean the council, recognizes that financial statements are prepared in accordance with GAAP are the goal, right? That's what we really would like. The accounting industry has developed standards over time, continues to refine those. We feel that that's a good way to measure earnings and to analyze and prepare statements. However, they say many producers don't have the records to get there, to follow GAAP. Now, the group that I'm talking to may be an outlier here. You guys may be better prepared than most, but a lot of folks that have a cash basis accounting system only, or just a check register or something, they're really not able to do that. And so the guidelines are really for that group, although we do have some examples of how accountant might issue statements that are largely following GAAP, but also do follow some of the guidelines or statements formats that we have suggested here. So the vision of the council is, to address critical areas where standards are needed. We really are just trying to supplement the existing body of knowledge. So FASB, the Financial Accounting Standards Board, issues statements. They have working groups. They issue these statements all the time for comment. Sometimes their changes are deferred. Sometimes they're rescinded. But anyway, I am not an accountant, and I appreciate the accountants on the council that kind of help me understand what the FASB guidelines are saying. So we generally just are trying to take those existing bodies of knowledge and refine that into more simple terms that will fit kind of in this cash to accrual approach that the guidelines are really addressing. And so we want to be sure that we're credible, that the standards are accessible, and we're looking, for acceptance. And I think with respect to the lending community, the guidelines have received pretty strong acceptance. Now, I wouldn't say that all ag lenders have adopted these, but many have, at least in part, and we'll go over that in a bit later. So it is a national forum. We do have people from all over the US. We have our annual meeting and we move around to different locations. But this national forum, right, we're trying to develop these implementation guides, and we really want to focus on consistency and uniformity and integrity, so that when we're looking at statements from a ranch out west to a crop operation out east, at least the numbers are telling us the same thing. Obviously, the structure is going to be different. Leverage may be different. Operating income statement leverage may be different. And so the core values here are that we've got a lot of people with a lot of different opinions on this. And so we want to be open to all of these views, and we don't want any particular association or interest group driving the way we go. This is really driven by the members. So we do have people from commercial banks. Farm credit system is largely represented. I had already mentioned the software industry, but we also have a lot of folks that work with farmers, FBFM folks, or formerly known as extension agents. And so those people all have a say in what we do. We don't always have agreement, but we really do try to drive to consensus on what we do. And the ultimate goal here is, that the guidelines that are delivered are in the interest of the customer, which are the producers and the practitioners that work with those producers. So we really do try not to let a specific entity drive where we're headed. I think that's been a successful value and goal that we've achieved all along. So there are really three key components of the guidelines. The first one is this promotion of uniformity or establishing recommendations. And that's really the conceptual piece of the guidelines. And so that talks about, for instance, revenue recognition, expenses. It gives examples on deferred taxes, on leases. So it goes through a lot of the issues that can be challenging. The next goal is really to develop some measures or ratios that can be commonly applied to all sectors of ag. And now I'm going to talk about that in a little bit more because we've changed that over time. And we have some forthcoming changes that I want to review with you here in a moment. And then the third leg is the benchmarking. So when the council was put together, it originally had as a third goal the development of a national database where institutions would be able to submit sanitized and anonymous data that could then be benchmarked. Well, that never happened. What has happened is many larger lending institutions have developed their own internal databases that they use. There is an entity at Minnesota. You guys may have heard of FinBin, University of Minnesota's. It's the Center for Farm Financial Management. They actually have an online database. Now it is Minnesota centric, but they are in about 12 states now. The further you go out from Minnesota, the fewer numbers you have of comparable or of farms that are in the system. But it really does work as a nice benchmark because you can apply lots of filters and kind of narrow things down. So that's the closest we have to a national database. Many land grant universities have something not quite as comprehensive, but Illinois does. Many other institution or state universities do as well. So just real briefly on the guidelines. So I actually have show and tell. It's just unfortunate I'm not there with you guys in person, but this is the current guideline. It's about 300 or so pages. It has, I think it's probably doubled from its original size. So the first copy was released in 1991, and you can see that, you know, every 2 or 3 years almost, with the exception of from 97 to 08, there was about a decade where not a lot happened. That was when some other things were happening on the management accounting guidelines, which I'll get to in a moment. But there's been a lot of activity. And since roughly 2014, we've tried to update things every year. And so there are changes that are coming out that will be published in January of 22. And so the current version that's on the website was published early this year, January of 21. And a few years ago, we also developed something called an implementation guide, and it's much shorter. It's like 16 pages, and it's really almost an overview. It's written for non-accountants, and it kind of walks through some of the key components of the guidelines, points people to specific sections in the guidelines of relevance. And in fact, there's a chart that I think is pretty helpful. It's called an implementation continuum. And actually Norm had some input on developing this, but I know you can't read that really, but you essentially are trying to find out where you are in terms of where your current financial system is. You know, are you dealing with cash, receipts and expenditures only? Are you on a cash to accrual? Are you on a double entry accrual system? Basically, and what you can do with that. But then it gives some ideas for how to migrate to the next level of improved data, data gathering, data information systems. So the other guideline that we have is called the Management Accounting Guideline. And Norm was involved in this. In fact, FBS Systems there's a case study in here that has been entered in FBS Systems, and so all the examples are from that. So you'll see that a lot of this happened in the early 2000s. So it'd been discussed for a while, but it really got kicked off in the year 2000. And so kind of that missing 10-year period on the council guideline was going on here from about 97 to 08. This book is a little bit different, but it really does lay out, if someone were to implement a management accounting system, how would they go about doing that? So it talks about a standardized chart of account. It does talk about profit centers, cost centers, setting those up, how one might go about doing that. So it's different from the financial guide in that it's not a conceptual document on how we are going to handle base value of raised breeding stock or finance leases. Rather, if we were to implement a management accounting system, here are the things we need to think about. How do we divide up responsibilities? How are costs going to be accumulated? And then how are they going to be pushed out? And so it does a good job of that, I think. The most popular of these books is this financial. It's guidelines. It's been around for a long time. Most people download that, but they are both available. They're available on the website that the council has. They're $30 each. So the council is a nonprofit. Many of your lenders have these, so it may be useful if you've not been involved to get a hold of these and look at that and see what your lender might be looking at. The website for the council is ffsc.org, and it's just been redone here within the last year or so, and it contains some articles. Every once in a while, some of the members will post some article. It's kind of got the latest news, but you can again go to get the guidelines from this site. And we are also looking for members here. So, if you want, I always tell people, if you want to tackle technical accounting issues and travel to exotic places, this past year we were in Amarillo, Texas. We were in Sioux Falls, South Dakota a few years ago. We were in Champaign, Illinois about 3 or 4 years ago. Have I got a deal for you? So you don't get paid and there's lots of calls, but it is a good group. It's been great to get to know lots of these people. Many of them I consider friends. And so it has been a really rewarding experience for me in my career. If anyone is interested, we are always looking for producers. That's probably the one area that we have the most need of, because they're the ultimate customer here. And so if any of you are interested in that, Norm can certainly point you in the right direction. Feel free to reach out to me as well. But anyway, it's been a really good group. So let me transition here for just a little bit, because I want to keep us on time here and just talk about some of the recent activities that we've been working with. And so we just had our annual meeting the end of July, and we have subcommittees. So there are 3 committees as part of the council. There's a technical, and then we have a finance and a marketing. And so the technical committee is the group that they're really the keepers of these guidelines. They're responsible for maintaining them, keeping them up to date and accurate. And sometimes we're simply fixing mistakes. But the past year, we've been tackling deferred and estimated income taxes. I alluded earlier that we've come up with a revised set of ratios. So I want to talk about those here just a little bit. And for this next year, for our 2020 fiscal year, which started July 1, we're going to be incorporating these ratios into the final book and actually fleshing out a little bit more of this notion of estimated income taxes, which I'll get to in just a minute. And then we've got some other activities that we're going to plan to talk about as well. So deferred taxes is an area that when I speak to lenders and I ask for a poll of how many ag lenders include deferred taxes on the financial statements they analyze, the answer is almost always no one. They may get statements with deferred taxes. They may look at it, but when it goes to entering it into their analytical software and meeting the standards that financial institution has, deferred taxes don't fit. When those ratings models were developed, they didn't include deferred taxes, so they are generally just removed. So when we work with producers, we We do talk about that. We do put those on the balance sheet, have the necessary adjustments flowing through the income statement, but what gets provided to the lender usually is taken off. And so that's a challenge. Now, aside from this deferred income tax, many lenders have adopted large portions of the guidelines, but deferred taxes is probably one that, to my knowledge, very, very few have, again, because of their credit scoring models. So kind of the issues here with deferred taxes, and we've actually made changes within the last 2 or 3 years of this because GAAP did. There used to be a portion of deferred taxes that were a current liability, and GAAP a couple, I don't know, 2 or 3 years ago said, we're going to put all of these as non-current. So everybody's working capital who showed deferred taxes improved because of that. So the deferred taxes are now all in non-current liabilities, even if they relate to the liquidation of current assets. So there are really 2 components of deferred taxes, right? The liquidation of our inventories, the receipt of receivables, offset by our payables and other accruals. That's the first object here. The second one then is our deferred tax on our machinery, equipment, breeding stock, raised breeding stock, buildings and improvements, where we have book tax differences. So if you're maintaining 2 sets of depreciation schedules, like most operations are, I would imagine in the room, you've got a set for tax and you have another one for management. We're going to have differences between our book and our tax. And so those differences also will affect the income statement. The third component, however, used to just be called deferred taxes valuation equity. And so one of the changes that has come about from the council in the last year has been to rename that third component estimated income taxes from valuation equity. And so it shows up a little bit lower on the balance sheet. It's not commingled with the other portions. So remember, the first 2 really affect income. This third one is simply about the difference between the market value of land less its book value. And so as that land appreciates, we show that on the market balance sheet. We also want to bring to bear on the liability side the potential tax implication from that gain. And so it's on the balance sheet, but it's only going to affect our valuation equity. And so as we have talked about this for years, and in fact, one of the examples in this financial guide, we have 2 appendices in here. One, Appendix A, is more of it's based on a Kansas ranch. So it's got corn silage, wheat, hay, cow herd. And then we have a larger operation that's really spread more with following the accountant guidelines. But both of these examples have deferred taxes. And so I just took one of those as an example to just show what deferred taxes looks like. And at least for the operation that we have in this guideline here, we almost double the amount of liabilities that we have on the balance sheet. So the deferred taxes are pretty significant. And as I'm sure you guys are all aware, right, when we start thinking about selling land, there can be some significant gains, not always, but many times, right? If that's has been purchased a long time ago, a lot of that stuff has a low basis. So anyway, the pushback that folks often raise with respect to deferred taxes is, well, but those aren't really going to come due, or maybe I'll pass those on to my children and I'll get a step up in basis. And that may be true, but we do know tax law is always changing. There's lots of debate right now about what's going to happen. And it really goes back to what's the definition of a balance sheet, which is what do I own and what do I owe as of the date of that balance sheet. And so if I were to liquidate as of that date, what would my obligations be? And so that's why they're there. So it really does change the makeup of the balance sheet. Now, the good news, I think, for many of us is that when we think about deferred taxes, we really have two components. And I guess when I'm saying deferred, I'm really I'm probably not being very clear, so I apologize for that. But I'm really meaning here deferred and estimated, right? All of these taxes that are contingent upon, selling all of our inventories, selling our land, recognizing all of those gains. The predominant, though, amount that goes on the balance sheet generally relates to the estimated income taxes. Doesn't affect the income statement. It's that portion that relates to the value of land and machinery and buildings that exceed their book value. So, and this is, I think, typical of many operations. The bulk of that is not going to hit the income statement. The bulk of that is just going to hit the statement of net worth through valuation equity. Anyway, I didn't want to make this about deferred taxes, so I'm gonna move on here. So the other thing that I wanted to talk about, some of our key activities, had to do with a new set of revised ratios. So back in 1991, when this original guideline was issued, there were a total of 16 financial measures / ratios. Now, word is that when that original committee met back in the late 80s, early 90s, they had everybody write down their top, I think it was their top 10 ratios or something, and they aggregated all of that. And there were, again, this is what I've heard, what I've been told, I wasn't there, that there were 200 the different ratios or metrics that came in. So I don't know, that seems like an awfully big number. So, but even if it's half that, that's a big number. So the fact that they were able to get that down to 16, I think is pretty amazing. And from what I gather, there was a lot of time spent narrowing these down, a lot of late night discussions to get that to those final 16. But this organization is always trying to be relevant, be sure that we're addressing the needs of what's going on. And so we added five of these ratios measures in 2007. So we were up to 21. So in the last 14 years or so, we have received lots of comments that there are too many ratios, or they're too repetitive, or they're not the ones that we want. So what we have voted on at the annual meeting here is to reduce these to 13. So we're basically getting rid of 8 of these. We are going to use this concept of alternative ratios. And so you could say, well, really there are 17 because you're giving an alternate, but the way we're presenting it, there really are only 13. You could use an alternate instead of one of the 13. It does remove what we're calling measures, or some of the number items that we have. So for instance, we used to have a financial measure called working capital, net farm income, EBITDA, about 3 of them related to repayment capacity. Those are gone. They're discussed, and there is a special mention of working capital, but because those numbers all are either coming off of the balance sheet, the income statement, or our repayment capacity, we just refer the user to that. And the ratios are all about combining numbers, right? And dividing those one into another generally, and then the resulting interpretation. So what we've ended up with are 2 liquidity ratios. Current ratio has been there all along, and working capital as a percent of gross revenues is a ratio that was added in 2007. So that allows us to size how much liquidity we want, or how much we should have. So current ratio is probably the most common ratio that is used, but it doesn't tell us how much working capital. If I have a target of 20% working capital, 20% of gross revenue, well, I know my gross revenue, I know what my target working capital should be. An alternate is working capital as a percent of operating expense. That's a common one that lenders use. On the solvency side, we're down to just liabilities as a percent of assets, or debt to assets. And so the other two that we used to have are alternate ratios. USDA, land grant universities, academics, I've seen a lot use liability or debt to assets. Equity to assets is generally used by farm credit, and debt to equity tends to be used by commercial lenders. So we expect that people will pick one. On the profitability side, we've kept return on assets, return on equity, operating profit margin, and we took some liberty and we moved something called asset turnover ratio from efficiency and put it in profitability, since we're really using those four together really as part of the DuPont financial analysis to really understand profitability. On the repayment capacity side, we've got two. We have something called total coverage or debt coverage ratio. That is a new ratio. So the difference between what we've had in the past, which was our term debt coverage ratio, and the debt coverage ratio is simply operating interest. That's the only difference. So operating interest is now in both the numerator and the denominator. It's becoming more and more common. It's kind of it's been I think a bane for many analysts to try and split out the term and interest portion. And so it's still an alternate, but the debt coverage ratio is now the recommended. And then the replacement coverage ratio just extends our repayment capacity to include replacement of our capital asset base. And then we have four more ratios related to our financial efficiency: operating expense, depreciation, interest, and earnings before interest and tax as a percent of gross revenue. So those have not changed. We did receive lots of comments from people. We had lots of new ratios recommended, but when it came to voting and debating this, this was the 13 that we ended up with. So if you have a particular ratio that you would like, join the council, come on to the technical committee, and you can be the flag bearer for that one. And we'll, because we certainly do revise these over time as needs come up. So I don't know how many of you are familiar with all of these guidelines, and I don't want to linger on this, but here is a listing of the categories of the original 16. It may be a bit small, so I apologize for that. And I will be getting you a copy of these slides so you can actually see it in more detail. But it lays out the original 16 by grouping. Then it shows you the 2007 ratios and what happened here. You can see the new ones coming on. For instance, the working capital as a percent of gross revenue. You can see quite a bit of changes in the capital or the repayment capacity section. And then what we're proposing for January 22 are the green items. The blue are going to be alternates, and then the yellow is a special discussion of working capital when we're talking about the working capital as a percent of revenue. So that's where we are. This has probably taken 2 years to get to this. We had more people on the financial ratios subcommittee than we had on the technical committee. It's been the most popular. The financial ratios just really seem to be popular. We've had a lot of interest, lots of discussion. It almost seems like we had lots of stops and starts, but we're finally there. So we got a few minutes left. I want to kind of turn here just kind of at the end and talk about what are some of the key recommendations with departures. And I alluded to this a little bit ago with a few of those, but this is just more of a broader list of what we see that are not always used. So for instance, lenders generally are just looking at a market balance sheet. Now, if you're a larger operation and you provide account prepared statements or you've got cost balance sheet, they'll likely use that. But many traditional lenders are just using a market. So having cost and market value of capital assets is still a challenge. The council did recommend a 2-category balance sheet as opposed to a 3-category balance sheet. We still see lots of 3-category. It's not that it's wrong. It's just that it's kind of hard to determine what an intermediate term asset is, and does it switch? Does it go from long-term to intermediate to current? Separating personal assets and liabilities, we still see lots of occasions where personal vehicles and household goods and stuff are just on the commingled with the farm assets. Treatment of withdrawals, technically not an income statement item, but we often see it there. We still see a lot of Schedule F as the source of cash receipts and expenditures, even though we know that it's tax, not cash. Deferred tax and capital lease, I already mentioned. And then one of the other last item here is depreciation. So when the original guidelines were issued, there was a comment. Now, again, this was in 1991, but there was a comment that tax was an acceptable form of depreciation for management. Now, we've had a lot of tax changes, and that statement didn't last for long, but it was replaced with, because of the accelerated tax methods, book is recommended. But we still see a lot of lenders using tax depreciation because it's right on the Schedule F. So, okay, so using the guidelines, we've got about 5 minutes left here. So some of the challenges with the financial guidelines are getting actual cash receipts and expenditures. This might be a little bit of a recap of the previous slide, but getting a book-based depreciation, getting cost basis of assets, our deferred and estimated income tax, raise or base value of raised breeding stock. So many of you may be larger, that you pool the costs related to raised animals and depreciate, but lots of operations don't have the ability to do that, and so they assign a base value. That can be a challenge. And then with the financial guidelines, allocating this to an enterprise or getting to cost of production and break even, those are all very difficult to do if you are trying to do this after the fact and you're trying to allocate revenue. Revenue is perhaps easier, but on the cost side, that can be a challenge, which is why we often, I think many of you implemented management accounting. And so there are still challenges with it. How do we allocate those indirect costs? Do we change that over time? So we work with some operations, and some of the overhead items are just kind of based on flat percentages as opposed to acres or passes per acre or head days or something like that. So how we allocate those costs can have a significant difference on our break evens, or on how we back into our cost of production. Some of the other challenges that both the financial guideline and management accounting get to is benchmarking. How are we using this information, and are we using it to compare ourselves with other producers? Well, that can be a challenge, right? I mean, each of you are unique. You probably have different levels of leverage. You have different production models. Often the best benchmarking is against yourself over time, but nevertheless, right, we have this tendency, we want to know how we're doing. How do we measure up to our peers? And so Finbin from the University of Minnesota that I mentioned a bit ago tries to do that. You just have to be careful, right, in who you're comparing yourself to get an adequate pool of producers that are similar to you. Another challenge is with break even. I mean, what does that mean? I hear break even so many times, I'm not for sure that I even know what it means. And are we trying to get to a cost of production? How much does it cost to produce a bushel of corn, or finishing hog, 100 weight of milk, is that just our direct and indirect? What are we doing with SGA and our other overhead? Does that include withdrawals, taxes? And then the lender, is it covering our principal payment to the lender? And so we just see lots of different ways cost of production is used in the lending world. And so I guess I just mentioned that because it's a challenge. If you have computed your cost of production on a per bushel or per acre or per head basis, that's great. And that's, I think, needed. But how comparable that is with other folks really depends upon how they are allocating costs, and where you are, right? So is it just cost of production, or does it go beyond that and start to include some of the overhead items? And then lastly here is, does this provide actionable intelligence, or is it just kind of nice to have? Does that cost of production help us with our marketing decision? Should it, or are they totally separate? These are probably questions that you guys may have on your own operation. And then I think the age-old challenges are these responsibilities aligned, right? Can the managers who are responsible for a particular cost center, are they able to make the decisions that affect the bottom line, or are they not? Are they not able to make purchasing decisions? And so the responsibilities don't align with the costs. So anyway, I'm not out here throwing out answers. I'm just throwing out some of the challenges. These may very well have been topics you guys have talked about in the past, but they just keep coming up as we interact with producers. So Norm, I've been yammering on for about 45 minutes here. I know I'm about out of time. I have one more slide, but I think maybe we ought to just stop here and see if there are any questions.
We have time for about one question or comment. Any? Yes, Daryl, here.
Thank you, Todd. This is Daryl. You probably remember me from several meetings. Daryl Ellis.
Hi there.
My question is, and as you move forward with the new guidelines, one of the challenges I've had in implementing with the FBS system, number one is FBS has the flexibility of managing WIP inventories at cost and then at market. Where I need some guidance is, how do we handle the inventory change number? Do we record that as within the cost section or within the revenue section? Well, we have the ability to do both. And what's the differentiation between crops and livestock on that question? When we have stored crop versus a growing crop, which is still, there's really no market value on it. Does that make sense?
Okay, well, so I guess let me give a caveat. First of all, I'm not an accountant. I believe that those changes in WIP per the accountant would flow through cost of goods. So that would be in the cost section, not the revenue section. I think one of the challenges we have here on the guidelines are that, you know, we allow flexibility for how producers want to represent that. So some operators, for instance, gains or losses on breeding stock hit revenue, but I think the way the management accounting guidelines describe that and the way accountants would handle that is that it would be in the expense section of the income statement. So anyway, I think I would say the expense section would be, but it would be a good thing for the council to take up, and we would love for you to be a part of it, Daryl. So I know you have been there before. So anyway, Norm.
Yeah, thanks a lot, Todd. We appreciate the firsthand report, and let's give Todd our appreciation. Thank you.
Hey, thanks everybody. I need to go, but enjoy the rest of your day, and hopefully I'll get to meet all of you in person at some point. So.